Okay, next up we have Stealth Global Holdings, ASX code SGI, and a market cap of around $15 million. Stealth is one of Australia's largest industrial distribution groups, combining company-owned and independent retailer assets, providing more than 1 million products, supplies, parts, and accessories to businesses, trade, and retail customers. A warm welcome back to Stealth CEO Mike Arnold. Mike, welcome back to the network.
Thanks, Paul. Good to be here again. Okay, if you could just take me through to the next slide, please. Recently we obviously announced our 2023 financials, annual report, as well as presentation deck. So this deck is a little bit different in terms of providing a high-level view, but obviously you can go to our website or on the ASX to look at our results and other elements in detail. We listed the business 5 years ago in October 2018. Since then, we've undertaken 7 acquisitions and a significant growth from $24 million in revenue at that time to $111 million that we've just finished in FY23. Our positioning from a strategic point of view has really evolved, and we've found that we've developed a position in the market that we can take a leadership position and the company of choice from an industrial supplies and solutions business. The main competitors that we have in the business space are Wesfarmers and Metcash, and then on the retail side of things would be Metcash and Sydney Tools. So we are absolutely looking to position ourselves as an alternative amongst them. And as I take you through the presentation, you'll be able to see that we've made significant milestone jumps over the course of not only the last 12 months, but in the prior periods as well. Our very simple motto is industrial products and solutions for every workplace. So that can be all in markets, business customers from multinationals through to mining companies, transport companies, to the local school in any office, or any other working environment, warehouses, and also for the individual consumer that is looking for a DIY product. And we found that both in the business space and retail space, we continually get growth in there. Our positioning from a commitment point of view is really about long-term growth and delivering shareholder value. So our pathway and our strategy has been really consistent over the course of, or since our listing. We maintain that view. We have regular updates, and we like to obviously deliver on those elements that we've said at the beginning of the year we're setting out to achieve. So next slide, please. So our overarching strategy, so we're 111 million today, as I said. Our target in the next 2 years, 200 million in revenue at an 8% EBITDA, the largest distribution network combining the assets of company-owned and independent operators. Our model really sits about a comprehensive assortment of quality products. So we have a significant amount of products at our disposal, both within our facilities, but also that we can pull on demand. Innovation has really been a key to our success, and expanding our services. So it's not just about a product, but it's all the ancillary items that go along with that and the services that, I guess in the most simplistic term, allows us to provide a one-stop shop. Everything that we do is all about sustainability, not only the operating practices that we have, but also the contracts that we enter into, both on the supplier side and also from a customer point of view. And integrating that right across our portfolio is really key. And I guess our maturity as an organisation has really stepped up in the last 12 months. And that's allowed us to not only have relevance, but we continue to evolve in digital capabilities as well as building our scale. So next slide, please. If I can just give you a bit of an overview of the size of our organisation. So founded in 2014 by myself, as I said, listed in 2018. We are a large player and one of the largest distributors in Australia, as Paul mentioned at the beginning. We are Australia-wide. We have 70 store locations that operate in every state. So that's a combination of company-owned as well as independent retailers. We have 200 employees, 39% of our staff is women. We have 200,000 products that we hold in stock at our distribution centres in our stores and also in other locations. We have 8,000 business customer accounts that we deal with every day, and that's repeat business. And in the last 12 months, we've had 34,000 individual retail consumers. So we're a large, sizable business with physical infrastructure, and we have quite a large comprehensive distribution network. Next slide, please. This is really just to give you a bit of a view of a breakdown of the products that we sell. And I guess on the right-hand side, you can see then the types of brands that we sell. So all the major brands, worldwide recognised, also Australia brands. So we have a good, better, best policy. We basically stock goods that we have good relationships with, but we also work with the customer based on the products that they're looking for. So our stocking model, as Paul said at the very beginning, we have 1 million products at our disposal. 80% of our revenue is the 200,000 products that we hold. Next slide, please. Our go-to-market model or strategy has really evolved, and we're in a position now that we cover multiple channels, varied customer needs, from complex requirements within large corporations and mid-tier down to the individual consumer. On the business side, we really operate two segments. So the business solutions, which is all tailored for businesses, government, and any other institution as such. And then we cater for retail. So retail is typically, obviously, in-store and online. On the business side, we sell anything from an individual product right through to a comprehensive arrangement whereby we will manage sites. We will also have mobile stores, containers and remote locations. They're all decked out with our stock. So it's a comprehensive value add, which is linked with technology, full visibility of and tracking of all our inventory. But it's very much driven as a solution with specialist people that we have in our organisation. Today, that's about 84% of our total sales, and the balance, 16%, is within retail. We completed 3 acquisitions in FY22, and we've just spent the last year, obviously, consolidating those. So the banners are Heatley Safety and Industrial. The Stealth organisation is really a corporate holding company, and the one that's operated market is Heatley Safety Industrial, United Tools, Industrial Supply Group, and C&L Tool Centre, and all those businesses we've acquired over a period of time. The reason why we cater for those two channels is ultimately the varying needs, and the demand of the retailer is very different than a business customer that we're really integrated with. Next slide, please. So our market, we play in a large market, 64 billion total market, 52 billion we would classify as our current addressable market. The largest player in that market, which is Wesfarmers, is about 4.5% market share. So it's attractive. And as you can see, I'll probably make the dot a little bit bigger, but 111 million, it's only people. So we see a significant opportunity for us to pursue opportunities and go really hard to pick up market share that we currently don't have today. You can see on the right-hand side that this is all driven out of IBISWorld. That's where we've completed all our research, but there's significant size in markets that operate there. And we're the only company of our type that actually caters for one source, one group of product that can cover all those particular categories. Next slide, please. The great thing about our product, which is a lead on from the markets we operate in, is that 95% of the products that we have are non-discretionary items. So with an economic downturn that obviously is currently underway, we can withstand that because it's an everyday commodity. We have really resilient end markets. So 32% of our total business, or total sales, I should say, is linked with mining, contractors, transportation. So we see that it's a favourable backdrop from the industry and it's ongoing repeat demand. We've recently been involved in the last 12 months in more tenders and bids than we've ever been involved in previously, and sizable ones are getting invited, and that's really just the maturity of our business. We've won 8 of those, and a lot of those are in its infancy, and they're large turnover sales. So our largest customer is about 5% of our total sales, and our largest supplier contribution is about 4%. So you can see that it's it is fragmented or diversified, but from a risk profile point of view, it's really well covered from that side of things. So we've got a really good, resilient business model. Next slide, please. So financials of FY23. We've had a record all over, record revenue, record profitability through all line items, and also record operating cash as well as record free cash flow. So revenue increased by 11.4%. It actually increased by 17.4% because we walked away from we closed 8 on-site customer contract stores. So taking that revenue out, we actually grew by 17.4%. So our cost structure has also been well managed. We've picked up 200 basis points over the last 12 months, and we've really successfully managed the inflation aspects, which is the cost of freight, cost of goods and wages and everything else, and rental. So the team within the organisation are absolutely credited for their input. Our EBIT has increased by 71.4% and our EPS increased by 51%. So at a 9.9% return on capital employed, it's definitely heading in the right direction. So in the first 4.5 years of our business, our mandate was about building capability, building scale, building revenue, building custom in the infrastructure that I've already showed you. This year, we've planned to increase our profitability, and that's really been our key focus. So you can see that from an operating cash point of view, almost $7 million. We've maintained our spend from a net capital expenditure point of view, which predominantly is e-commerce. And from a free cash flow perspective, we generated $5.6 million, which is an outstanding effort, particularly as our cash realisation ratio is at 130%. We also paid down our debt by almost 30% in the last 12 months, which is an outstanding result by my finance team and everybody within. The $7.2 million worth of debt that we have, only $2 million of that actually relates to fixed debt, which will be paid off within the next 12 months. The balance is working capital related for everyday need. So obviously a business like ours that has almost $15 million worth of inventory within its facilities, that's an everyday requirement to make sure that we can leverage early settlement discounts, we can leverage bulk buys, and our margins have increased because of that. So our ratio net debt over EBITDA at 1.4 is exceptional and at a level that we're quite comfortable with. And when the debt we went into was based on the acquisitions that we've made, 4 acquisitions actually in the last 3 years. But from an inventory point of view, we are down to 13.3%. 2 years ago, that was 16%. So we continue to run at the same rate. There'd be $3 million worth of extra inventory. So we've got substantial working capital headroom, and our metrics have actually been a really pleasing result for us. Clearly, our push will continue towards profitability, but we see that in a hockey stick type of situation as we go forward. Next slide, please. So just to give you a bit of an idea of trends, so you can see this is revenue. We've had consistent half by half growth, and similarly within our gross profit. So 5 years ago, actually, our gross profit contribution was 18.4%. So we've increased that to a high 29s, and our target is mid-30s. And the initiatives of that with the blend of our own private label product as well as scale, better buying power, and so on, will help us continue to grow the business. Next slide, please. These are really achievements over the course of the last 12 months, and this is about really enhancing our core business and also right-sizing. So we've gone through pricing reset, which has added 70 basis points to our gross margin. As I said earlier, 200 basis points from a improvement in our cost structure. We vertically integrated 2 acquisitions into one and aligned our sales force for different customer types, which has helped us also onboard a number of customers on our e-commerce platform. And clearly with AI and everything else, we were ahead of the game on that, but automation is key, and we've made significant steps there. Probably the only other thing that I'll mention on this slide is we consolidated, after having 6 companies, we consolidated all the master or tier 1 supplier arrangements which were operating in every different company into one. So we now have a central purchasing office that is responsible for the commercial negotiations and ensuring there's consistency and better engagement, deeper relationships with suppliers. And that's probably in its teenage years, but significant uplift in that alone, to the point that there's identified $200 million worth of new potential revenue by us putting in business model that we're looking to put forward. Next slide, please. So from an outlook, there's 2 slides left. 95% of our product, as I said, is non-discretionary. So we're really feeling good and buoyant about our growth, to the point that we expect continually double-digit growth, both in revenue and profit and cash in our earnings. We are continually looking to consolidate the acquisitions that we've made, and we've already shortened 7 into 4 brands, and we're looking to consolidate that further so that we can add more grant and investment within our business. But despite the fluctuations that have occurred from an economic point of view, we absolutely are continuing to keep high demand for our products and services. So next slide, please. And I guess wrapping it up from an investment point of view, we're an industry challenger at the moment, but we're absolutely taking market share. And we're in a great market, lots of opportunity, as I showed, with the largest player at 4.5%. Our customer value proposition is really powerful. It's been purposely built. We've looked internationally at the best operating models, and we've put that back into our business today. So the operating models or the go-to-market models that we put together from a business and retail point of view put us in a really strong competitive position, and we're seeing that just by the contracts that we've won. And from a financial point of view, we're ticking the boxes and everything that we set out to do, which obviously includes adjusting wages for our staff, incentivising our staff, making sure that we provide the right services there. So the purpose-driven cultural aspect is really about making sure that everything we do is about a commitment to excellence, whether that be service delivery, the people we employ, the way that we engage, the shareholders that are obviously involved in our company. It's really driven from a purpose point of view, and our organisation is now set to cover both business-to-business customers as well as business-to-consumers, and we're really excited about where we're heading. Lots of opportunity in our space. As I said, those other companies, those 3 companies, we're looking to sit side by side them, so we're the alternative that's coming through, and we're really excited about the future. Thanks, Paul.
Thank you, Mike. That was a really, really good, thorough presentation. Thank you. Got plenty of questions for you. First up, can you give us an update on the progress with the integration of the recent acquisitions such as C&L, Skipper and United Tools?
Yes, so let me start with Skipper. So we acquired that in August 2021. We've actually consolidated 3/4 of the operations. We've got 2 more to go. What will happen is the Skipper Transport Parts name will go. We will convert all operations into Heatley's, which is Heatley Safety and Industrial today, but it'll be Safety, Industrial and Automotive. And that's a prominent brand, and we'll push that. From a United Tools point of view, we've consolidated that with Industrial Supply Group. So all our individual members now fall under one banner. And we had our first large conference in Sydney, where we had 40 major suppliers attend and showcase and do a trade show within about 1,500 odd square metres. And we've got fantastic uplift in that. So one operating system, we found so much efficiency just in administrative aspects. In fact, one of our accountants was saying the other day, 1,113 invoices were processed in 1 month just for one supplier. He's been able to cut that down to 3. So there's just a lot that's going on there, and really positive. And the uptake, when I spoke about the 200 million revenue opportunity, that sits within that group. And lastly, C&L Tools is a business that we acquired in 2021 as well, and we've doubled the profit since that time. And we've also increased revenue by about 50%. So we've looked at the efficiencies on that. And obviously they worked their way through COVID and still continue to grow. And in-store channel they offer, they have an online model as well, and really prominent in the Queensland space.
Right. And how is the ramp up of the key large contracts won over the last 12 to 18 months going? And what is the outlook for further wins in 24?
Multiple tenders that we still have, record tenders that we're going for. We've got a number sitting out there now. So we've won a number of tooling contracts in the northwest of Western Australia that we've been supplying construction in Karratha and also in Port Hedland to the tune of about $3 million, which has beat expectations in the first 12 months. We also now look after a large mining contractor that has 4,000 people available. We provide their workwear and all their head-to-toe safety equipment, from glasses to helmets to gloves to earplugs to boots and everything in between. What we're finding with these companies is that once we integrate from a systems point of view, all the pricing's online, so it makes it so much easier for them for their purchasing. We run dedicated reports through Power BI that they can run their own usage. They can see what purchase orders are outstanding. They can, go through and get full spend visibility as well. We're finding that by doing that, they're actually giving us new categories and asking us to quote on new categories and pick those up because they find the simplicity of our systems really helpful. And we've spent $3 million in the last 3 and a bit years on e-commerce. We did that really early on because we knew that this was a requirement, and we're receiving the benefits of that now.
That's great. And investment in working capital reduced significantly in FY23. How much can this reduce further over the next, say, 2 to 3 years?
Look, I think every business can run its inventory a lot better, and we're obviously one, so we're working on our turns. And whilst our inventory, we think that we run really well. The great thing about our business is that we don't actually have any expiry dates. But obviously, in one particular market, if a product isn't moving, what we find in most cases it actually moves in another market. So, for example, if it's not selling in Sydney, it might sell in Brisbane. So we actually just shift product between each place to maximise, obviously, the working capital that's involved in inventory. Now, in saying that, we're a business as well that should be generating good cash. There's examples of peer groups that are getting a mid-40s return on their capital employed overseas, but they're also generating significant cash flow. And their inventory turns are only about 6 times, and we've got 8.2 times. So we're definitely building and heading in the right direction. And I guess the technology piece that we put in allows us to have full visibility of everything, so that allows us to manage our cash better. We're a light capital model. So the idea of us expanding our business into 70 stores and combining independents was that takes forever, and it's a significant tens of $1 million worth of infrastructure spend, and we haven't had to do that, but we're still reaping the benefits of it.
Gotcha. And just want to finish up here, Mike. Yeah, you reiterated FY25 targets of 200 million revenue, 8% EBITDA margins. What are the key drivers that will enable you to reach this, and how much of this will be organic driven, and how much will be acquisition driven?
Yeah, I've been asked this lots of time. The big push is organic. We do look at acquisitions every day, so maybe if I just answer the acquisition one, we've looked at many acquisitions. We're active in that space. they've got to be able to, it has to be value accretive before we would bring it in. And, you know, in the last 12 months, we haven't completed an acquisition because they haven't been value accretive. But there's definitely consolidation in the market, and we will absolutely continue on that path to consider the right ones. From an organic point of view, our focus is growing with our existing customers at least double digit in all aspects, and that's growing every customer from large to small, increasing our online presence. So the online sales element has continued to grow on average about 40% year on year. And so there's a lot more from a marketing and advertising level that we are doing there. And the big piece, as I mentioned, is there's this pot of $200 million of actual spend that is today, that is within the portfolio of all the independents, and all the suppliers are dealing individually with the independents. So if we bring that into one pool, the efficiency for the independent is everything's online. They don't have to process it. And for the supplier, they have one debtor. And that in itself brings all that revenue through our organisation and better buying power. So, you know, 3 suppliers in itself are around about $60 million worth of revenue, which we're well down the track of hopefully finalising those discussions to onboard them.
Mike, it's been an absolute pleasure to have you on today. Many thanks for taking the time, and you have a great weekend.
Yeah, you too. Thanks, Paul.